Introduction to Diversification and Risk Management in the Indian Stock Market. Welcome to Session 8 of our course on the Indian Stock Market for Beginners. Today, we will discuss diversification and risk management in investing. Diversification involves spreading investments across different asset classes, sectors, and companies. Risk management tools like stop-loss orders and hedging can help protect investments. Diversification reduces the impact of any single investment on your portfolio. It potentially lowers the risk of significant losses and increases consistent returns. Asset allocation and sector diversification are two ways to diversify a portfolio. Stop-loss orders are predetermined sell orders that limit potential losses during market downturns. Hedging involves taking positions that offset potential losses of existing investments. Risk management is about managing and mitigating risks, not eliminating them. Thorough research and continuous monitoring of investments are essential. By diversifying portfolios and employing risk management tools, investors can navigate the uncertainties of the stock market.